A candlestick chart pattern is a financial chart used to represent the movement of an asset's price over a specific time period. It consists of a series of candlesticks, each of which represents the price action for a particular time period, e.g. a day, an hour, etc. Each candlestick has a body, which represents the opening and closing price of the asset during that time period, and a wick, which represents the range of prices that the asset traded at during that time period. Doji. This pattern occurs when the opening and closing prices of a candlestick are nearly the same, resulting in a very small body. It is seen as a neutral signal, indicating that the market is in a state of indecision. Hammer. This pattern occurs when a candlestick has a small body and a long lower wick. It is seen as a bullish signal, indicating that the bulls have pushed the price up from a low point. Inverted hammer pattern. This pattern is similar to the hammer pattern but occurs after a downtrend. It is seen as a bullish signal, indicating that the bulls may be taking control of the market. Shooting star. This pattern occurs when a candlestick has a small body and a long upper wick. It is seen as a bearish signal, indicating that the bears have pushed the price down from a high point. Hanging man. This pattern is similar to the hammer pattern but occurs after an uptrend. It is seen as a bearish signal, indicating that the bulls are losing momentum and the bears may take control. Engulfing pattern. This pattern occurs when a small candlestick is followed by a larger candlestick that completely engulfs the previous one. A bullish engulfing pattern, green followed by red, is seen as a bullish signal, while a bearish engulfing pattern, red followed by green, is seen as a bearish signal. Dark cloud cover. This pattern occurs when a green candlestick is followed by a red candlestick that opens above the previous day's high but then closes below the midpoint of the previous day's green candlestick. It is seen as a bearish signal, indicating that the bulls are losing momentum. Morning star. This pattern is a bullish reversal pattern that occurs after a downtrend. It consists of a long red candlestick, followed by a small candlestick that gaps lower, and then a long green candlestick that closes above the midpoint of the previous red candlestick. Evening star. This pattern is the opposite of the morning star and is a bearish reversal pattern that occurs after an uptrend. It consists of a long green candlestick, followed by a small candlestick that gaps higher, and then a long red candlestick that closes below the midpoint of the previous green candlestick. Bullish engulfing pattern. This pattern occurs when a small red candlestick is followed by a larger green candlestick that completely engulfs the previous candlestick. It is seen as a bullish signal, indicating that the bulls have taken control of the market. Bearish engulfing pattern. This pattern is the opposite of the bullish engulfing pattern. It occurs when a small green candlestick is followed by a larger red candlestick that completely engulfs the previous candlestick. It is seen as a bearish signal, indicating that the bears have taken control of the market. Three black crows pattern. This pattern occurs when three long red candlesticks are formed in a row. It is seen as a bearish reversal pattern. Three white soldiers pattern. This pattern occurs when three long green candlesticks are formed in a row. It is seen as a bullish reversal pattern. These are just a few of the many candlestick patterns that traders use to analyze the markets. It's important to note that no single pattern is 100% accurate and traders should use a combination of technical indicators and fundamental analysis to make informed trading decisions.